The last time the stock market did this, everyday people became millionaires, and now it's happening again. But with one big difference: this time no one is paying attention. And this is crazy because it could be the last opportunity to build wealth this fast for this decade. And what's even more crazy is the fact that everyone thinks the market is boring, overvalued, or too quiet to be worth their time. And I want you to hold on to that question for a moment, because it sets the stage for everything we are about to talk about, and it is much deeper than it appears. Because today we are witnessing a pattern that the market has only produced a handful of times in the past century, and every time it appeared, it created generational wealth for the people who recognized it, while those who ignored it or dismissed it as just noise later found themselves looking back, wondering how they missed something that, in hindsight, seems almost obvious. And I want you to imagine the moment when the internet first started spreading across the world, not when it was mainstream, not when everyone used it at work or checked email every 5 minutes, but the very early period when only a small minority understood what it truly represented, when most people brushed it off as a nerd experiment, when people said nobody would ever shop online, when people thought that websites were nothing more than digital posters. And yet there were a few individuals who noticed a quiet shift happening, a shift that wasn't loud or glamorous at first, a shift that did not come with flashing headlines or breaking news alerts, but a shift that completely transformed the world and made early observers unbelievably wealthy. Right now, the stock market is going through something incredibly similar, and I want you to understand it step by step. Not in a complicated way, not in a way that feels like reading a textbook, but in a way that builds layer after layer, like peeling an onion, where every layer reveals another level of what is happening beneath the surface. Because the truth is that what you see on the charts, what you hear on the news, what you might think is simply a normal upward trend is actually the visible part of something much deeper, a structural change in the market that has been forming quietly for years. And the breakout we are witnessing now is not random, not accidental, and not just optimism, but the release of an enormous amount of market pressure that built up during a long consolidation period. And to really understand how powerful this is, you need to think about what consolidation actually means. Because consolidation is not simply a sideways movement or a boring period where prices drift and nothing exciting appears to happen, but rather consolidation is like a giant coil compressing itself, storing energy, building up strength, waiting for the moment when the pressure becomes too great to contain. And then, once the breakout triggers, the market moves with such speed and intensity that by the time the average investor realizes what is happening, the majority of the gains have already been made by the people who paid attention early. This is why the last time this happened, so many people became millionaires, not because they were lucky, not because they had insider information, not because they were mathematical geniuses, but because they recognized that a long consolidation followed by a high-volume breakout is one of the rarest and most powerful signals in market history, a signal that appeared before the explosive bull runs of 1982, 1995, 2013, and even earlier periods like the post-war expansion of the 1950s. And each of those breakouts launched multi-year cycles that produced enormous wealth for anyone who positioned themselves before the move fully matured. So, if you want to really understand what's happening behind closed doors, make sure to stay until the end, because I will analyse everything in detail. Leave a like and let's start with the first layer. But keep in mind that every layer is more deep and important, especially the fourth one. So, the first deep layer is something market technicians call structural breadth expansion, which sounds complicated, but essentially means this. Instead of only a few large companies pushing the market upward, a broad collection of sectors and industries begin participating at the same time. And when breadth expands after a multi-year consolidation, it creates the foundation for a sustained bull market, because it signals that money is not flowing into just one trend or one narrative, but into the market as a whole. Breadth expansion is extremely rare because it means hedge funds, institutions, pensions, quantitative funds, and long-term allocators are all quietly agreeing, without speaking to one another, that the long-term risk-to-reward balance has shifted, and they begin positioning huge amounts of capital into equities again. But here is the mysterious part. They do it silently, gradually, and slowly at first, because big money never announces when it is buying, and retail investors rarely notice the signs until it is too late. To understand even better, imagine a field where thousands of small lights begin turning on one by one. Not all at once, but in a pattern that slowly illuminates the entire field. And at some point, the light becomes so bright that everyone sees it. But by that time, the people who turn their lights on early are already far ahead. Before going on the second layer, I remind you that if you want to open a YouTube channel like the one you are watching and make a lot of money from it, I have a free Telegram community with the link below where I can help you back to before. The second technical layer, which becomes incredibly important once a breakout begins, is something called liquidity repositioning. And this might sound like economic jargon, but it is one of the clearest indicators of whether a breakout has real power behind it or whether it is simply a false move that will collapse on itself. And liquidity repositioning refers to the way market liquidity shifts from defensive assets like bonds, cash equivalents, and money markets back into risk assets like stocks, high beta sectors, and growth equities. And this movement is extremely important because markets do not rise on optimism. They rise on liquidity. When liquidity comes back into equities after a long consolidation, it acts like fuel being poured onto dry wood. And once the spark ignites, the fire grows fast. And if you learn to spot this liquidity movement early, you can understand why the breakout you're seeing now is not noise but something far more significant, something that aligns with the major millionaire-making cycles of the past. The third layer, which most people never even consider, is volatility compression. And this is one of the most reliable signals seen before large bull markets. Because when volatility compresses tightly for a long period while prices hold above key moving averages, it means the market is coiling, absorbing supply and preparing for expansion. And when the expansion finally occurs, it often becomes explosive. This is why experienced traders watch volatility ranges the same way scientists watch pressure inside a system. Because once that pressure exceeds a threshold, the system does not release energy gradually, it releases it suddenly, and people who anticipated it are positioned in advance while everyone else is caught off guard. But there is an even deeper layer beneath all of this, a layer that most retail investors have never even heard about. And it is something that connects all the previous elements together into one cohesive force, and that is intermarket confirmation, which refers to how different asset classes, like bonds, commodities, equities, and currencies, begin confirming the direction of the market by moving in alignment with one another in a very specific pattern. And when you see this alignment during a breakout, it is often one of the strongest signals of a genuine structural trend shift. And I want you to keep this in mind as we continue peeling back the onion, because once you see how these layers fit together, you will understand why the current moment is not just a simple push upward, but something that could replicate the exact same type of breakout that last time made so many people wealthy. Are you starting to understand why this moment is so special? No? Well, that's why most people don't realize what's happening. But stay tuned, because the deeper we delve into the levels, the more everything will begin to come together. And if you learn to recognize those hidden layers, you position yourself not only to ride the main trend, but also to tap into the multiplier effects that historically create wealth far faster than simply buying the index. Because once the breakout happens, the next question becomes, where does the money go first? And that brings us to the second major layer of this market environment, the leadership rotation, a phenomenon that happens at the beginning of major bull cycles and determines which sectors become the engines of the next large move. And the fascinating thing is that leadership rotation is rarely driven by the sectors that performed best during the consolidation. Instead, it is driven by the sectors that built up the most stored momentum beneath the surface, sectors whose fundamentals quietly strengthened while prices remained suppressed, sectors whose earnings growth accelerated while valuations reset, sectors whose balance sheets improved while the broader market remained distracted. And when the breakout occurs, these sectors explode upward, because they become the natural destination for new liquidity. To understand this, imagine you have 3 runners lined up at a starting line, and while they wait for the race to begin, one of them's doing tiny warm-up movements that are hard to notice from far away, preparing their legs, increasing their oxygen flow, getting ready to sprint. And then when the starting gun fires, that runner takes off instantly because they were already primed for acceleration. And that is exactly what happens with leadership sectors at the beginning of a breakout cycle. But I want to take this further and make it more technical, because leadership rotation is not random. It follows measurable patterns that repeat across decades. And the first pattern to understand is relative strength emergence, which occurs when certain sectors begin outperforming the index even before the breakout becomes visible. And if you can spot this early relative strength, you can front-run the leadership that everyone else only recognizes months later. For example, when the 2013 breakout occurred after years of sideways movement, technology and discretionary stocks were already showing relative strength under the surface months before the index finally broke upward. And when the 1995 breakout happened after a long consolidation, semiconductors and software quietly emerged as leaders long before the mainstream investor realized what was happening. And when the early 1980s breakout finally launched, the financial sector had been showing structural strength for almost a year. The reason so many ordinary people became wealthy in those cycles was not because they guessed, not because they took reckless risks, but because they recognized the early emergence of leadership sectors and positioned themselves when prices were still compressed, valuations were still attractive, and liquidity was just beginning to rotate. Think of the market as a river system, where liquidity is water that always flows downhill, but it does not flow in a straight line. Instead, it flows into the path with the least resistance. And leadership sectors are the channels that open up first during a breakout, allowing the water to rush through them faster than through the rest of the system. The next layer beneath leadership rotation is something even more powerful, something that many investors underestimate or overlook: earnings acceleration combined with multiple expansion, a dual-force mechanism that acts like a twin engine, propelling certain stocks far faster than the market itself. Earnings acceleration means the rate of earnings growth is rising, not just the earnings themselves, and this creates a compounding effect because the market tends to assign higher valuations to companies whose earnings are accelerating. And when you combine accelerating earnings with expanding multiples, you get explosive price moves that can massively outperform the general market. This is the type of dynamic that created legendary wealth during past breakout periods. It's what made early tech investors wealthy in the mid-90s, what turned basic consumer discretionary names into rockets in the early 2000s, and what fueled financial stocks in the early 80s. And now is a lot easier with YouTube. You can literally replace your 9 to 5 in just 2 months if you do the right things with YouTube, since now is on easy mode, and it's blowing up every small channel that does things right, as I teach you in my free Telegram community with the link below. But now I want to take this even deeper into the onion, because beneath leadership and beneath earnings, there is an even more technical layer that often goes unnoticed, and that is the macro confirmation layer, which consists of long-term economic conditions aligning with the breakout in a way that historically produces multi-year expansions. For example, you often see falling inflation combined with rising productivity during major breakouts, or declining interest rate volatility combined with strengthening labour markets. And these macro conditions create an environment where companies can expand margins, improve profitability, and invest in long-term growth, which further accelerates the bull cycle. But here is where it becomes very important for you as a potential investor, because this is the layer where most people make mistakes, either by acting too emotionally or by failing to understand how the macro layer interacts with the market layer. And if you misunderstand this relationship, you might misinterpret temporary pullbacks as reversals or underestimate the strength of the breakout. Because during the early stages of a breakout, volatility tends to rise temporarily as markets adjust to the new trend. But this volatility does not necessarily mean weakness. More often, it is simply the market recalibrating and shaking out short-term traders who expected a straight upward move. And this shakeout phase is often where the best entries occur, yet most investors avoid it because they let emotions influence their decisions. Then, beneath the macro layer, we reach another hidden layer, one of the most important: capital expenditure cycles, which refers to the long-term investments companies make into technology, infrastructure, operations, and future expansion. And this becomes extremely important during breakout periods, because capex cycles indicate whether companies are preparing for growth or retreating from it. When you see a breakout combined with rising capex, especially in sectors showing early leadership, it often means those companies are preparing for multi-year expansion. And historically, this combination has created some of the highest returns for investors who position themselves early. But if you want to understand how to actually use all these layers to your advantage, you need to go even deeper, because the stock market is not just driven by fundamentals, not just by technicals, and not just by macro conditions. It is also heavily influenced by behavioral liquidity, which refers to how human psychology moves money in and out of risk assets during different stages of a cycle. For example, at the beginning of a breakout, skepticism is high, participation is low, and bearish commentary is everywhere. Yet this is usually the most profitable time to invest. Then, as the breakout continues, skepticism gradually turns into curiosity, and curiosity turns into confidence, and confidence eventually turns into euphoria. And understanding this behavioral progression allows you to anticipate when the breakout still has years of potential ahead of it versus when it is approaching exhaustion. And I want to give you a very simple mental image to make this clear. Imagine a giant stadium that is slowly filling with people, and at first only a few people walk in, while everyone else waits outside because they aren't sure the event will be worth attending. But as more people walk in, the energy increases, and eventually those outside begin to notice the noise and wonder if they should have gotten inside earlier. And by the time the stadium is nearly full, the latecomers can't find seats, because the opportunity has already moved on without them. This is exactly how market sentiment evolves during a breakout. Early skepticism, mid-cycle acceptance, late-cycle euphoria. But before we move into the next layer, I want to touch on something extremely important that can dramatically shift your understanding of this environment. Market microstructure, specifically how liquidity providers, algorithms and institutional order flow behave during breakouts. Because contrary to what many people believe, breakouts are not smooth and clean. They are full of fake-outs, traps, liquidity hunts, and consolidation zones engineered by the natural functioning of order books. And if you understand this microstructure, you can recognize when a temporary pullback is simply the market seeking liquidity rather than reversing. For example, during a breakout, you often see something called a liquidity sweep, where price briefly breaks below a support level to capture stop-loss orders, only to reverse upward with greater strength because the sweep created liquidity for large buyers to enter positions. Recognizing sweeps, traps, and accumulation zones allows you to see what the market is doing behind the scenes, not just what it looks like on the surface, and this dramatically increases your ability to position early. But even beneath microstructure, there is one more hidden layer, the one most people never talk about, and it's also the last layer: interdependency cycles, which describe how breakthroughs in one sector create demand in another, which then triggers growth in a third, creating a chain reaction that drives the entire market higher. And these interdependencies can amplify returns in ways that seem disproportionate to fundamentals. This is where the onion metaphor becomes incredibly powerful, because by now you can see that the breakout at the top is just the visible tip of a massive structure beneath it. And if you understand that structure, you can navigate it like a professional investor rather than a spectator. And that understanding becomes the difference between watching others build wealth and participating in the wealth-building process yourself. This also happens when you watch others build a lot of YouTube channels. You watch them building wealth, but you never start, so just take action. But now I ask you again the question I asked you before. Are you starting to understand why this moment is so special? Probably yes, so you can begin to see why this moment in the market is so significant. Because once a long consolidation ends with a confirmed breakout supported by breadth expansion, leadership emergence, liquidity rotation, macro alignment, and rising capex cycles, what you are witnessing is not a normal market rally, but the early stage of a structural bull market. The kind of move that only happens a handful of times in an investor's lifetime, and the kind of move that makes the people who recognize it early appear almost unnaturally lucky to everyone else who discovers it too late. But you might be wondering, how do you actually use this moment to your advantage without falling into the traps that so many investors fall into during the early phases of a breakout? How do you avoid buying the wrong sectors at the wrong times? How do you avoid chasing overextended moves or panicking during temporary pullbacks? And how do you position yourself in a way that is both strategic and resilient? And the answer begins by understanding your position in the cycle, because every investor plays a different role depending on whether they enter early, mid-cycle, or late. If you are entering early, meaning right after the breakout or during the first round of pullbacks, your priority is not to find the perfect price, but to get exposure to the leadership sectors while their trend is still young. And the best way to do this is by using a tiered accumulation approach. where instead of buying all at once, you buy in increments during orderly pullbacks and consolidations, because early cycle volatility can shake out impatient investors, but disciplined accumulation during controlled dips allows you to build a strong position that benefits from the long-term trend. If you are entering mid-cycle, your strategy becomes more selective, because by this time some leadership sectors have already made significant moves, and while they may still have years of upside ahead, you need to focus on companies within those sectors that are showing accelerating earnings, strengthening balance sheets, or emerging innovation catalysts. And you also need to watch for secondary leadership sectors that typically emerge after the first wave, such as industrials, financial infrastructure, or niche technology, the segments that benefit indirectly from the core trend. If you are entering late cycle, meaning after valuations have stretched and sentiment has become euphoric, your strategy must become more defensive. Not in the sense of abandoning growth, but in the sense of focusing on companies that have durable cash flows, strong margins, and consistent demand regardless of economic conditions. Because late cycle gains are still possible, but they require a more cautious approach. And your objective is to collect the residual upside without exposing yourself to excessive risk. But regardless of whether you are early, mid, or late, one of the most important tools you can use during a breakout cycle is what professional investors call trend validation, which means continuously checking that the conditions that justified the breakout in the first place are still intact. Because as long as liquidity remains supportive, breadth remains healthy, leadership remains consistent, and macro conditions remain aligned, the breakout retains its structural integrity. And even if the market experiences temporary corrections, those corrections often become buying opportunities rather than signs of reversal. Another crucial technique is understanding sector rotation timing, because leadership sectors do not remain dominant forever. Eventually, they pass the baton to other sectors, and if you can understand the timing of these rotations, you can significantly enhance your returns, because instead of riding one sector until exhaustion, you ride multiple sectors as they take turns leading the cycle. This rotation typically occurs in waves. Early cycle performers tend to be growth-based sectors, like technology, communications, or consumer discretionary. Mid-cycle performers tend to be industrials, financials, and energy-related segments. Late-cycle performers tend to be commodities, value stocks, and defensive sectors. And understanding this sequence allows you to stay aligned with the natural rhythm of the breakout, rather than fighting against it. But beneath the rotation layer, there is another deeply important concept: market scaffolding, which refers to the underlying economic structures that support a bull market as it grows, such as productivity gains, technological innovation, fiscal stability, regulatory clarity, and demographic tailwinds. And during historical breakout cycles, these scaffolds strengthened over time, allowing the market to sustain long-term expansions, even when short-term data seemed mixed. For example, during the breakout of the 1950s, productivity gains and industrial expansion created the scaffolding. During the 1982 breakout, declining inflation and advancing technology created it. During the 1995 breakout, the internet and globalization played the role. During the 2013 breakout, smartphone penetration and cloud computing created the foundation. And today, new forms of automation, digital infrastructure, and operational optimization appear to be forming the scaffolding that supports the current market expansion. If you understand the scaffolding, you can differentiate between a breakout that is speculative and one that is structurally supported. And right now, the evidence strongly suggests that the current breakout is supported by long-term, structural forces, not short-term speculation, which is one of the reasons why it resembles the scenarios that historically produced new waves of millionaires. But to truly use this knowledge effectively, you need to incorporate one more layer: portfolio architecture, which means structuring your investments in a way that matches your risk tolerance, your time horizon, and your understanding of the cycle. Because even in a strong breakout, the wrong structure can limit your gains or expose you to unnecessary losses. A well-architected portfolio during a breakout often consists of a core position that tracks the broad market or the leading sectors, surrounded by satellite positions that target high-growth opportunities within those sectors, and complemented by risk controls such as staggered entries, periodic rebalancing, and allocation caps to prevent overexposure. And this architecture allows you to participate in the breakout while managing the unique risks that come with a rapidly expanding market. Another element of portfolio architecture is time-based scaling, which means adjusting your position sizes based on the age of the trend rather than on short-term price movements. And this method helps prevent emotional decisions because your adjustments are based on the cycle rather than on fear or greed. But beyond architecture, så vi finner and dynamikrobi or the next layer is something extremely practical that most investors overlook. Data cadence, which refers to how frequently you evaluate your portfolio, your thesis, and the state of the market. During a breakout, checking too often creates emotional noise, while checking too rarely can make you miss important signals. But if you adopt a cadence aligned with the cycle, such as reviewing macro data monthly, sector data weekly, and positions bi-weekly, you maintain clarity without overwhelming yourself with information. Then, beneath that, we have another subtle but powerful concept: signal filtering, which means learning to distinguish between meaningful market signals and noise. Because during a breakout, the market produces a huge amount of noise. Endless opinions, contradictory headlines, analyst revisions, macro speculation. But the strongest investors filter this noise by focusing on the signals that matter most: liquidity flow, breadth trends, earnings trajectories, and sector rotation timing. If you can master signal filtering, you avoid the trap that catches so many investors during breakout cycles, reacting emotionally to short-term fluctuations instead of focusing on long-term structural forces. But the layer that ties everything together is cycle psychology, because the evolution of investor sentiment is one of the most consistent and predictable forces in the market. And understanding where we are in the psychological cycle allows you to anticipate what comes next. Oh, and remember that now we are in the best moment to start a YouTube channel, so let's give it a try by clicking the link below. During long consolidations, you see pessimism, boredom, and apathy. During early breakouts, you see disbelief and skepticism. During mid-cycle expansions, you see acceptance and engagement. During late-cycle peaks, you see excitement and euphoria. And finally, during reversals, you see denial and regret. Right now, the market is still far from euphoria, still far from excitement. And this is exactly why the opportunity resembles the moments that historically made ordinary people wealthy. Because millionaire-making cycles rarely begin during euphoric times. They begin during skeptical times when most people don't believe the breakout is real. And now it becomes clear why the last time this happened, so many people became millionaires. Because they were early enough to see what was unfolding, they understood the structure behind the breakout, and they aligned their strategy with the cycle instead of fighting it or ignoring it. And if you apply the same level of understanding, discipline, and patience, you position yourself to potentially benefit from the same type of structural opportunity unfolding right now. Because the truth is that the market is not just rising, it is revealing something. And the people who know how to read that revelation are the ones who capture the most significant gains. Not through luck, not through guessing, but through understanding the layers that make up the entire structure beneath the breakout we are experiencing. If you take anything from this long exploration, let it be this: the market is not moving randomly, and the breakout you are witnessing is not a temporary spike, but a structural release of energy built up over years of compression. The last time conditions aligned this way, it marked the beginning of multi-year expansions that rewarded disciplined and informed investors far more than they expected. And the same possibility exists now for those who recognize the pattern before it becomes obvious to everyone. And while nothing in markets is guaranteed, understanding the layers, the breadth, the rotation, the liquidity, the macro scaffolding, the psychology, and most importantly the structural context, gives you an advantage that most people never take the time to develop. The next wave of wealth does not go to those who react the fastest, but to those who understand the deepest. And by understanding this moment, you are already ahead of the majority. I want to leave you with a question. If you've made it this far in the video, it means what I'm explaining to you in my free Telegram community works, right? So join with the link below, and let me know if you expected this in the comments, subscribe to this channel, and see you soon.